If the market can hold above the 200-day moving average through Friday of this week and through Friday of next week, right? So time is a very important factor here. If it can maintain above that 200-day moving average through Friday of next week, the correction is over.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you here at the end of another week. I'm joined as usual by my great friend, the sexagenarian portfolio manager, Lance Roberts. Lance, how you doing?
Yeah, I don't know about the sex part, but the 60 part is right. So,
I'm sure we've got some people in the comments who are saying, hey, this guy's a sexy portfolio manager, but sexagenarian is a fancy term for somebody who is 60 years old, which Lance just turned a few days ago. So Lance, happy birthday.
well, thank you so much. I appreciate it, and I feel 90, but hey, 60 is okay.
Well, you know what? As we were saying before we turned the camera on, it's just your second time around on 30.
Exactly. Great way to look at it too. So
Well, anyways, folks, please wish Lance, give him happy birthday wishes in the live chat or in the comment section below. We did send a nice little thoughtful money gift there for Lance. It's collectively from all of us, but Lance, I want you to feel the love here from this audience. Very much appreciate everything you do, especially the fact that you're willing to come on for so much time every week, again and again here on this channel. So thank you.
no, it's my pleasure, and always love being here. It's always a lot of fun. So, but I do appreciate the gift very much, and it's very well appreciated. So thank you.
Well, look, the gift is way too little for everything that you do, but I just want you to know that you are very beloved and appreciated here at Thoughtful Money.
Well, thank you.
All right. Well, look, it's a fair amount to get into this week. Real quick, before we do, just one quick shameless plug. At the time we're recording, Lance, you might remember we had our little a little competition on X in terms of followers, and I ended up passing you a little bit earlier this year. I am now poised. I'm at 99,400 followers right now, so I'm like that close to 100,000 followers. Folks, if you don't follow me on X yet, please take a second and do. I'll put up the handle here on the screen. It's at Menlo Bear. I'll tell you guys the story behind that at some point if you're interested. If you're interested, let me know in the comment section below. The reason why you should think about following me on X is if you enjoy these videos, you like the material that we get into here. I do my best to create as many of these videos a week. We're doing about 5 to 6 a week at this point. But there's a lot that happens in between the videos getting recorded, especially in this year that we're in right now with so much change on it happening hour by hour, minute by minute sometimes. And X is really where I track that, share my thoughts, share data that I'm finding throughout the day. So it's a way to kind of, if these videos alone don't scratch your macro itch, following on X, you'll get the full stream. You should also follow Lance too. And Lance, I think you're just at Lance Roberts on X, right?
Substack at Lance Roberts, X at Lance Roberts, Twitter. What do you call it? Is it? I still hear people. I still call it Twitter.
I know it's hard. We should call it X, but it's
X.
everyone will know what you're talking about if you say Twitter.
Pretty much, if you want to follow me, LinkedIn, X, Substack, it's all at Lance Roberts. So
all right. And just to complete the trifecta, there also is an official Thoughtful Money X account as well. And if you don't follow that, take a second to do that as well. That's just at Thoughtful Money. All right, enough of the commercial there. All right, Lance. So the question I've been dying to ask you over this week is the sell the rip guidance that you guys have been advising, is that now over? Has that been negated by this kind of monster rally that we've seen? Because I think last week we were approaching what could have been resistance technically, and I'm pretty sure, but you can bring the chart up. I'm pretty sure we punched above that now pretty decisively.
Yeah. So no, the sell the rip part isn't over with yet. In fact, I would encourage you. And again, so let's just take a step back here for a moment. I want you to remember how you felt on August the 7th. So on April.
Yeah.
I'm 60, right? I have dementia.
Hey, your first senior moment. Congratulations.
Right. So on April the 7th, I want you to remember how you felt. I want you to remember, I want you to go look at your portfolio value, where you were on that day, and I want you to remember what you were thinking, right? And most likely you were in panic mode, worrying about how far this market's going to decline, the bear market's back, blah, blah, blah. And I wrote on April the 6th. So if you go to our Substack or if you go to our website, realinvestmentadvice.com, look on April the 6th, I wrote an article. It was entitled The Hope and the Fear. And Adam and I even discussed it here on the show that Friday. And the point was that juncture, there was so much panic, so much technical destruction to the markets. We said it in that article, said this is probably the low of the market, and we're going to get a rally here. And in fact, 2 days later, we actually added some positions in our portfolio, took advantage of that rally. Now, the question has been up to this point, so fast forward, is this a bear market rally that's going to fail and go back down and retest lows? And we've been tracing out, last week, Adam and I kind of went through the whole analogy of the 2022 correction, where we had this big initial decline, a rally back, big rally back, and then the market failed, went down, set new lows, and then we eventually bottomed in October. And I said I hate analogies for a whole variety of reasons, but most likely is that markets never track previous markets exactly the same way.
Right. But I will say, for the chart you showed last week, pretty spooky how close it has tracked it so far this year.
More spooky this week because it's like point for point, we are now back exactly to the peak of that rally that we had back in that first leg in 2022. So right now it's tracking the technical indicators on a weekly basis. The price action's tracking exactly the same. So if this market's going to roll over and fail here, it's going to do it now. But having said that, okay, so that's the bearish side. The bullish side is that we've broken above the 50-day moving average. We've broken above the 100-day moving average. We've broken above the 200-day moving average, and the market's holding up there. If the market can hold above the 200-day moving average through Friday of this week and through Friday of next week, right? So time is a very important factor here. If it can maintain above that 200-day moving average through Friday of next week, the correction is over. So that doesn't mean markets are going racing off to new highs, but any pullback you want to get, it is now a buy the dip opportunity. So what I'm saying is this is where it gets a little challenging from an investment standpoint, is that we have to wait here a little bit, give this market some time to declare itself. And if this market is going to roll over, and if you're going to have another corrective leg of a bigger corrective cycle, it's got to happen now. If it doesn't happen now, the odds are that we're going to challenge all-time highs within the next month or so. So that's the challenge here.
All right. So market seems to then be at a key junction here, and basically the next week will be the tell.
Right. Exactly.
Okay, and folks, I should note too, and Lance, I'm sure you're going to pull up the charts pretty quickly, but we are recording this a day early in the week. So this week we don't have Friday's data, and folks, that's on me. I have to catch a flight tomorrow, Friday, so was not going to be able to record on Friday, and so we wanted to still bring you the recap. So we're just recording it a day early on Thursday.
Right. And so yeah, we are missing a couple of key points here, but here, let me bring up a chart for you real quick. Are you seeing my chart?
Yep, we see it.
It is doing something funky over here. So what I did this
I understand that as you get older, technology becomes harder to work with, Lance, so don't worry, we'll be patient.
Wait, I'm not squinting at the screen yet.
Yeah,
so
if you need to put your readers on, we'll wait.
So this is a chart that I posted out this morning in our daily market commentary. So again, if you follow me on Twitter or you follow me on Substack, Lance Roberts either one, every morning we post out daily market commentary, and in that we always cover every day some aspect of the market in terms of where it is, what to expect next, what's happening, something related to trading your portfolio. So this was this morning's layout before the market opened. We've had this very nice retracement rally. We've retraced about 75% of that decline. In fact, markets were positive as of yesterday for the year. So if you had just gone to sleep on January the 1st and woke up today, despite all the move in interest rates, despite all the move in the stock market, they're flat for the year. So again, you wouldn't even notice that this was all going on if you just hadn't been paying attention to it so closely. But I've laid out three pathways here for the markets, and we can assign some probabilities to this more than anything else. But the first one is this kind of first pullback to support that horizontal support line. That's the 200 100-day conjunction. That's where those two moving averages are coming together. That's also the top of that initial rally that we had back in kind of early March following the initial decline when we're down about 10%. We had that little rally back. And it's also the bottom of that sell-off that we had back in January of this year. So you got a lot of support right there that's built. So there's about a 50% probability that markets are going to hold that support level. And if they can do that, work off a little bit of this overbought condition we've got right now, then that kind of sets the market to rally up towards around 6,000 over the next couple of months. If we fail that, then you've got a whole bunch of support right there at the 50-day, 20-day moving average, which also happens to be about the 38.6% retracement level on a Fibonacci basis. But that's also that bottom that we had back in mid-March. So you've got a lot of support there. The market can hold that. That's actually a decent entry point that the market could rally from there and then kind of move back up into better territory. Now, if we take those levels of support out, we're back into a bear market. This was a bear market rally, and we're back into correction mode, and something has happened. Trade negotiations have completely fallen apart, or there's some other type of event that's going on, and that's putting pressure on prices. Economic data just completely disintegrates over the course of the next couple of months, and we're kind of staring at the face of a recession type thing. Which that would lead to a very sharp reduction in forward earnings estimates, and that would bring down the price of the market to readjust for a valuation shift. But that's, you break that second support level, basically it's risk off at that point. But that's probably a 10 to 15% probability at best right now. You're above that, 85% probability this correction that we had is now over, and we're just going to kind of work through and then try to rally probably sometime into kind of maybe July, have another kind of consolidation period in August, September, and then you get your year-end rally to close out the year.
Okay, so a couple questions. And first off, I think your pacemaker's chirping at you, Lance. So I don't know if you can turn that down or not.
My pacemaker, it's my people at work texting me. So and I forgot to put my phone on silent. So there, done.
No worries. Okay, so which one of those, and I'm maybe guessing it's the more dire of the three, if we were to continue to follow the script, if the spooky correlation were to continue, which line there would we follow? Correlation with 2022.
Yeah. So that would be more along the lines of the third piece. Let me see if I can. I actually posted an update of that chart here real quick. Let me see if I can find it. Can't remember. It was either Tuesday or Wednesday. Yeah, here it is. So this is where we were as of Tuesday morning. So you see how closely we're tracking that 22 correction. So basically, we're not much above where we were on Tuesday as of this morning. Thursday. So again, this is kind of just tracking right along that way. So if you get into that third leg, if we get into that 15%-ish type position, you're looking at potentially a retest of lows. I don't think we're going to set new lows in this market unless something's really going wrong. But even a downshift back to the previous lows, that's going to be, market will be down again near 20% from the peak. You're going to have a lot of pressure on markets in a lot of places. So, that's what that would look like. But that's a very low probability event. The reason you have a higher probability event of a pullback and then another rally is that hedge funds are still very, very short. You've got buybacks still in full swing right now. In fact, those are accelerating at a pretty rapid pace. And earnings estimates right now are actually ticking back up for the Mag 7. So you're seeing the Mag 7 earnings tick back up. That's starting to lead to better earnings breadth across the board. And earnings and forward guidance in the first quarter was actually pretty good. So you had a few companies withhold guidance. Walmart did today as an example. But by and large, most companies held guidance and stayed with their previous guidance. They didn't make big adjustments for concerns over tariffs or whatever that is. Doesn't mean that can't come. But just right now, those kind of underlying fundamentals still remain pretty solid.
Okay. And I know you don't like these tracking analogs, and I get it because they work right up until they don't.
Exactly.
So, everybody kind of bets the farm on it continuing, and then all of a sudden, so this may be the point where those two lines begin to separate, right? Yeah.
Exactly.
Okay. You don't necessarily have to pull it up, but back on the chart you were showing, we were at pretty elevated levels on the MACD and the RSI.
Yes,
How
we
much
are.
does that concern you, if at all?
No, those aren't concerning, but what those tell you are is that this is a good time to maybe think. And so I started this conversation and I didn't finish. I need to go back to finish the conversation. I started out the conversation saying, remember how you felt on April the 7th in your portfolio. And, if you were up at night and you were, gnashing your teeth and biting your fingernails and they say that you find religion in two places, right? And one of them's in foxholes,
Hmm.
and the other's in the stock market. And when you start praying, it's like, oh dear Lord, please just, if you'll just let me have a bit of a rally so I can get out of the market. That's your point to say, emotionally, that's where you step back and say, should I be buying? Right. Because that's, you're at max pain at that point. And from a contrarian basis, that's when we will start buying stocks. Now you're probably going, man, this market's back, it's going up. I need more risk. This is where, think back how you felt on, April the 7th. And this is a good time because you are overbought on a short-term basis. MACD, relative strength and momentum, you're overbought. This market's it's gonna give you some type of consolidation, at least, if not a small pullback. So take some profits, rebalance your risks. Things that have not been performing, time to let those go. Things that are performing well, trim those back, hold your positions. Palantir, one of the companies that we bought on April the 6th, is up 60% since April the 6th. So, it's
Wow.
some of these stocks have just, Nvidia's up, the most hated stock in the index, Nvidia is up 48% from the lows.
Yeah. Super micro, I heard, is up a ton too.
Yeah. So, that whole Mag 7 is dead, aspect is over, right? Because again, you and I have talked before, is the one thing you're not going to beat in this market. You can make all these claims that you want, but who buys back the most stock? It's the Mag 7.
Right.
Who has the biggest weights in ETFs. So every time these people every time this market rallies, retail investors were piling into S&P ETFs, triple Qs, those type of things. Every time they pile money into those ETFs, it goes right into those stocks. So whenever you get these rallies, those are the stocks that are going to lead the way for the most part. And that's exactly, what's been the case here lately. So again, this is why it's always good to have good diversification in your portfolio, have the growth, have the value, have some of your defense, have your offense, and manage that risk. But this is a good time to go reevaluate your portfolio and say, look, I'm going to take a little money from here. I'm going to add a little bit of money over here. We're still carrying a short position in our portfolio. That's going to get let go here on any pullback. But we've got a little bit of a hedge still. We're still overweight cash. So we're looking for some type of pullback here to increase our equity exposure, reduce our hedges, and get our portfolio back onto normal footing.
Hey, sorry to interrupt, but a few weeks ago you told us that you had downshifted your equity exposure, right? One of those 25% downshifts. Have you moved that back up to 100% yet or not?
Not yet. Again, we're overweight cash. We have a short, so that's keeping our equity exposure
Yep.
underweight. So we're underperforming right now on this rally. So on a relative basis, we're underperforming. On an absolute basis, we're still well ahead of the markets. But
Yep. You had the slack. You were playing it safe. You explained that for us. It made sense. Yeah.
So short term, we're underperforming. But no, the weekly sell signal is still in place, and that keeps us a little bit underweight here right now in terms of equity risk. But that indicator is starting to turn back up as well. So we've had this kind of this sell signal that doesn't occur very often, this weekly sell signal. But in bull markets, it tends not to last very long. Like for instance, a good example in late 2015, like October of 2015 through February of 2016, that was the whole Brexit exit. And, we had the markets were selling off. You had two back-to-back near 20% declines, just boom, boom. And then the Eurozone came in and started doing their version of QE and the markets took off.
Mm-hmm.
So that weekly indicator kept you out of the kind of the volatility mix for a bit. But then as soon as it turns positive, then you go back full equities. We're not quite there yet, but another week or two potentially of being where we are right now, we're probably going to flip that indicator back up again.
Okay. What are you going to need to see to go more aggressively long, right? To say, hey, it's time to start playing it as conservative we've been, and this market's now convinced us we're maybe in the upper of your three scenarios there.
So I would, what would really help is that we would get, if I had my ideal dithers right now, we get a pullback to the 200-day moving average. The market would hold that, flop around for a few days, work off the overbought condition, then rally, take out the most recent high, which was on Monday. And when you do that, you've now got a confirmed breakout and retest of support. So you've broken above resistance, turned it back into support, and then the breakout of the previous high then tells you that support is in place. And that pretty much gives you kind of an all clear sign to get more aggressive with your overall allocation.
Okay. So obviously, folks will be tracking this weekly with Lance going forward, and whatever happens, Lance will call the audibles for us, and he'll let us know, what his firm decides to do otherwise. Okay, so you've already kind of expressed the sentiment, but you just released a piece, Lance, that said now is not the time to be greedy.
Yep.
And I'm assuming I didn't have a chance to really read it, but I saw the headline. Is it mostly what you just said here, or is there any other?
No,
Is there more to that to talk about?
No, that's really the juxt of that, which is, we managed right at $2 billion for 2,000 families, and we have a group of clients that are absolutely the best contrarian indicators, because when markets are selling off, they're like, oh my gosh, get me out, put me all in cash, and then as soon as markets are rising, like, we got it. Why are we all in cash? We got to be all back in, right? They're your best contrarian indicators. And this is what I was saying earlier is just, if you're, when markets rally, we throw all of our risk management out the window because we get greedy and it's like, oh, this market's going to keep going and stuff like that.
We being people, not we being RIA.
Oh yeah. We being the general investor, right? Just as human beings, it's our nature. And so we tend to throw caution to the wind when markets are going up. And then, when markets go down, all of a sudden we realize just what risk really is. And this is the big factor is risk is not about how much money you make. It's about how much money you lose when things go wrong. And so this is why you and I always talk about risk management, position sizing, taking profits, rebalancing and doing all those type of things. It's very mundane. And yes, it limits your gains. If I just put, Google in my portfolio or Nvidia in my portfolio and just left it alone, it would be 10% of my portfolio now because it's grown so much over that time frame. But that also means that if that stock goes down, if it's 10% of my portfolio now and it goes down 20 or 30%, it's taking 2, 3, 4% out of my portfolio because it's such a big weight. And that's something that's very hard for investors or individuals to stomach, is that loss of principal, because we make all these mistakes about measuring the high water marks. In fact, I've got an article coming out, I think next week. It's talking about anchoring. And one of the biggest mistakes that we make as investors is we anchor to the high water mark. Mm-hmm. So if you look at the market this year, everybody was talking about, oh, it's a 20% correction from the peak. Yes, from the peak of the market to the bottom of the trough, it was 19.2% on the decline. But that's not where the year started. And it's not where we were a year ago. And, so all of a sudden, when you start, and we talked about this before, but when you start expanding your time frame to look at important marks of where your capital was, where it is now, all of a sudden you can take out a lot of this emotional risk by getting the right anchor points. And so, anchoring is one of the biggest problems we have, is that we mark to the high water mark and you have this decline. It's like, oh my God, I'm losing all this money. But markets are only down 6% for the year, right? Because you already had such a big rally. And, those are the type of things that we need to work on. And that's what risk management will help you do, is just navigate that volatility.
Okay. Well, look, we got some news out this week, some data, which I'll get into in a minute, but I guess maybe before I do that, let's go into bond yields.
Sure.
So Lance, I'm sure you're getting the emails, but I got a few this week saying, hey, please discuss this with Lance. Bond yields have been creeping up. I did talk about this a fair amount this week, both with Danielle DiMartino Booth and then with this week's interview with Bill Fleckenstein. But Lance, what is driving them back up to what, 4.5% now here? And why are they why are they proving so hard to tame when more certainty is coming into the market now, right? Totally understandable that bond holders got worried when Liberation Day, surprised everybody. When folks got caught underwater in the basis trade, right? But those basis trade players have had a chance to repair their balance sheet. We're now getting clarity, not crystal clarity, but more validating clarity on the trade deals. There's more data that's coming out. Why is that not quelling bond yields?
So a couple things. First of all, if you go to our YouTube channel at The Real Investment Show, and we post this every day, Michael Leibowitz and I spent about 30 minutes this morning talking about all the reasons why bond yields move in a certain direction. So one way or the other. So if you want a much more in-depth discussion, go to our YouTube channel and look at today's YouTube show, The Real Investment Show with Lance Roberts. So we do a lot of work on that. But the bottom line is you have to separate out narrative versus what drives prices. And, so a lot of people talk about it's the debt, it's the deficit. Those are narratives. That has nothing to do with what moves bond prices from one day to the next. And what moves bond prices in the short term is just simply traders on Wall Street. And right now there's a big short position against treasuries at this moment because that's the trade that's making money. And so if I can keep shorting enough of bonds, and you've got a lot of hedge funds, a lot of big players in that space that have the tiger by the tail, so to speak, they've already got big short positions and they can continue to put enough pressure on the short side to drive yields higher in the short term, and they can make money on that trade. That's part of that basis trade that we talked about previously. They can do that to work in their advantage. And we see that a lot right before auctions. You'll see that going into an auction, like the 10-year or the 30-year, you'll see yields jump right before the auction. And that's the traders coming in, driving up the yields on treasuries so they can buy them cheaper at auction. Makes sense, because as soon as I buy them at auction, then I've got an undervalued asset, and then yields come back in, I make money. And then they sell the bonds and they start the whole process over again. So from 1 day to 1 week to 1 month, interest rate moves don't make any difference other than what's just happening on Wall Street, because it's just all what traders are doing. Long term, this is, yields are going to go lower because it's simply a function of the debts and the deficits. And it's like, well, no, deficits make yields go higher. No, they don't. And all you have to do is look at 10-year treasury yields versus the deficit going back to 1980, and they track each other almost identically. Because the more debt and deficit you have, the slower rate of economic growth you have, the less inflation you have, which drives yields lower. So yields are always a function of economic growth and inflation, because if I'm loaning money for 10 years or for 20 years or for 30 years, whatever I'm loaning money for, I've got to loan it out at the rate of economic growth plus inflation, so to speak. So right now, that yield should be, economic growth is around 2%. Inflation's running at 2.3. Add those two together, my yield should be about 4.3. That's about where it should be. As economic growth gets to 1.6%, which is where it's headed, and you get inflation down to 2% or less, you're now going to be talking about mid threes on yields. And if you get into a recession, you're talking about sub twos on yields, because now you've got an economic contraction. So that's going to pull yields lower. If the Fed starts cutting rates, that's going to pull yields lower as well, just because of the function of the unnatural buyer in the market. So so longer term yields will decline. In the short term, they can be very volatile, which is what they've seen. And right now, as I said, you've got a lot of pressure on yields just simply from traders that are in the markets right now that have that ability to short the treasuries, make money with it. But if they get caught on the wrong side of this trade, and all of a sudden yields start to come down because all of a sudden recessionary data shows up for some reason or the other, and if we start getting a real bad spat of economic data where recession really looks like it's a probability, then traders are going to get caught on the wrong side of that trade. They're going to have to cover the short position. That's going to drive yields down very quickly.
Okay. Just because you mentioned recession, I was going to mention this at some point today, but Jamie Dimon just spoke today. He's saying, "Hey, I wouldn't take recession off the table." You know, the media is all of a sudden back to everything is awesome,
Yeah.
and so you got Dimon here saying like, "Well, I'm not entirely sure." Right now, he's not necessarily calling for recession, but you know, important that he thought it was meaningful enough that he should speak out and just say, "Hey, folks, slow your roll on this."
Which is
Um,
interesting because I'm trying to look up the date here real quick. On May 13th, JP Morgan drops US recession call after US China trade truce.
Yeah, no. Maybe that's a message to some of his own people. I don't know.
Yeah.
But basically, it's just his way of saying, as you say all the time, Lance, is don't just follow the headlines,
Yeah.
right? Okay, so and look, and, you know, I've had you and Michael on so
Yeah.
often to talk about your overall outlook on bonds, and it largely is, as you've said there, it is your confidence that the economy is slowing and that will bring down inflation expectations and that will bring down bond yields.
Correct. And there's also one big point of view. Remember, we're not trading bonds, right? So bonds for us are not a trade. We don't trade bonds because we're not bond traders. You and I, we talk about our 60-40 allocation model, which has 40% bonds in it. It'll always have bonds in it. It doesn't matter if the world ends, it's going to have bonds in it because it's a 60-40 allocation. Now, the duration of those bonds may expand or contract, and we do that all the time. We expand the duration, but that model is because it has lower volatility relative to the market. So again, when you talk about that 20% correction, peak to trough, the market was down 19.2%. Our portfolio was down 4.5. So that's the value that bonds play in lowering that volatility and allowing people to maintain their stability and maintain their allocations through volatile times so they can get to their financial goals. And here's another thing to remember about bonds as well. Let's say that if I could come to you right now, Adam, and say, look, I'm going to give you an investment that's guaranteed to grow by 45% over the next 10 years. You can take it?
I think there's a lot of people, yeah, sure bet, right? But that's bonds at 4%
4.5%.
yield, right?
Yeah. I buy you a bond at 10%, a 10-year bond at 4.5%, and 10 years, you get all your money back plus 45% return. So, I mean, we've got to remember what bonds do within a portfolio and quit worrying about the price volatility. The price volatility is irrelevant. It's always interesting when it comes to bonds that people watch the daily price movement of bonds and they forget about the whole principal protection value of what bonds provide you. But you ask them about their house, I go, what about your house? Says, oh yeah, not worried about my house. My house is going to be worth more in 30 years.
I'm not selling that for at least 10 years.
But the price of your house is going up and down every single day. It just, the price for a house may be less tomorrow because of whatever's happening in the markets than it was the day before, but you don't care about it because you have no intention of selling it. And so very important, and it's unfortunate that we don't spend more time in the financial media talking about how bonds actually work, what drives the value of bonds, how they work within a portfolio. We spend all our time talking about stocks and values and fundamentals, but we don't talk about the value of what bonds actually bring to a portfolio. And it's unfortunate because if people understood it better, I think you'd see people have a lot more bonds in the portfolio than stocks.
So let's remedy that if folks here are interested. Folks, if you'd like RIA to do, a webinar that's just dedicated to the fundamentals of bonds and their role in a portfolio and how to use them well, in the way that Lance is talking about, let us know in the comment section below. And if so, Lance, I'm presuming, you and or Michael would love to do that, right?
Do it together. Maybe we get a threesome.
Hey, that would be great.
Not
Well,
on the comments. Get out of the gutter. I don't mean it.
Yep. No, I right. Yeah, let's make it a trinity. That's maybe a better way to say it. Okay, so just for full disclosure, I I don't like to share my personal allocations, just because I'm concerned that there's a lot of people that watch these videos and they might say, well, if Adam's doing that, I'll just copy it, right? And what works for me very well may not be the right thing for you given your personal situation. But I will tip my cards a little bit and say, for a good while now, I have had more bonds than stocks in my portfolio. A lot of them have been very short. A lot of them have been very short duration, but I have had more bonds than stocks. Um, and Lance, you're right. You know, they play that role. I mentioned this just because it recently happened, but it is not a common event. You can have a year like 2022 where stocks and bonds were so positively correlated that bonds didn't provide the anchoring that they normally do, but that's generally a very rare event. Um, so where I'm going with this, Lance, is, okay, so you kind of made it clear what you think and why you guys are doing what you're doing there at RIA. Now, there's a lot of people that, a year and a half ago got all whipped up, partly because of discussions we had here about TLT, right? Which is a fund that tracks the longer end of the bond curve, more, I think, average duration around 20 years or so, right? And I think there's an understandable question that those folks are asking now, which is like, hey, it hasn't really performed all that great. And if I'm still in it, like, am I holding on to something that is either going to turn soon and start doing better, or maybe I need to reevaluate my bond exposure and not necessarily use a long duration ETF like that?
Yeah, well, so look, I think you have to start with the basic question of why did you buy it, right? Well, I bought it because Lance said rates are going to go down. Yeah, they are going to go down. But when did you expect rates to go down? And so we always talk about duration risk in a portfolio, and as we're looking at our portfolio and why are we buying something, how long do you expect to hold it? And it's always fascinating to me, Adam, that people say, oh, I bought this stock and I'm going to hold it for the long term. I'm going to own this stock forever. I'm going to own the, I'm going to buy TLT and I'm going to own it until yields come down. And as soon as it doesn't work, all of a sudden it's like, well, this isn't working. What do I do with it now? And all of a sudden that what we originally said we were going to do with the investment all of a sudden becomes a really short-term trade. We had a long-term view when we bought it. Now we have a really short time frame because it's not working the way we want. So you got to evaluate why you're buying things and understand your personal emotional mentality about owning it. Say, look, I don't really have a long-term view on stuff because as soon as this thing doesn't work, I'm going to want to sell it. So I need to realize that my holding period is 3 days to a week or whatever it is. And if it's going up, that's great. I'm fine. But I do realize my own error in my ways is that as soon as this goes down, I start losing money, I'm going to want to sell it. So if you bought TLT and you were expecting it to immediately start performing your portfolio and it's not, cut it loose. There's nothing that says, and this is one of the mistakes that people make, and they get into this mentality. It's like, well, if I sell it at a loss, then I can't buy it back. Yeah, you can. You can sell it at a loss, wait 30 days, buy it right back, and it's fine. And I know a lot of you are saying, well, as soon as I sell it, it's going to go up. Yeah, probably. That's the way things generally work because you're selling things when you are most emotionally distressed. You were wanting to sell everything in your portfolio April the 7th. Now, you can't wait to buy more and markets are overbought again. So emotionally, we do things always backwards. We're always doing everything backwards that we can in our portfolio. And that's why the average investor loses money over time. Very few individuals make money managing their own money because they get trapped up in all these emotional cycles. But the most important thing to understand is why do you own an asset, and why what's the purpose of that asset, and understand that there's a risk management process that goes along with that. 3 weeks ago, Adam, I took a bunch of grief on your channel because I said gold super overbought. It's going to pull back. And it's had a very nice pullback over the last 3 weeks. Now it's actually looking pretty appetizing to buy it. It's sitting on a good moving average support. Technically, it looks good. But people that bought it 3 weeks ago, they're underwater. So again, understanding your time frame, understanding what your goals are, understanding how things work in your portfolio, and understanding how to do some basic risk management is key to surviving volatile periods in markets. But there's no reason to own bonds if you don't understand them. Peter Lynch, one of the great investors of all time, ran the Fidelity Magellan Fund. He says, buy what you know. If you don't understand bonds, don't buy bonds.
I think it's a great point. Although I would say, to your point earlier, most people don't own bonds. Yeah. And for most investors, it's because like, oh, bonds are kind of mathy, right? And the pardon me?
It's that math thing. Yeah.
It's that math thing. But I mean, yes, they are mathy. And that's actually one of the advantages of bonds is you can really calculate down to several decimal points what your future return is going to be if you hold to maturity, right? Um, and the math isn't that tough. I mean, it's still basic, pretty much basic multiplication and division. And so, I would say if you don't understand bonds, if you say, look, they feel a little too mathy to me, I wouldn't say, well, that's not a reason not to own them. It's a reason not to just buy them blindly. And this is, again, sort of where a financial advisor comes in, which is get help. Go talk to an expert who knows how to construct a portfolio where stocks and bonds are working together in the way that you talked about earlier, right? So, I wouldn't use it as an easy excuse just to say like, well, I kind of don't get them, so I'm not going to invest in them. Say, well, no, they're a really important part of a diversified portfolio. Go talk to an expert and see if you can come up with a strategy that works for you.
Yeah. Well, and again, one of my basic lessons that I learned the hard way over almost 40 years now of managing money is money's just money. And it is not worth sitting up at night, losing sleep over a bad investment. The best thing I ever learned to do was how to sell something at a loss. And if you can get comfortable with that, your life will be so much better. If you can just say, that's not working for me, I can take that money and I can put it to work somewhere else that is making money for me, your life will become so much better. And that doesn't mean just everything that goes in the red, you immediately sell it. Sometimes things go down, just because they're overbought and they need to have a correction. Nvidia, Google, Amazon, all these stocks have had big corrections. Earnings are still growing. Fundamental, Google trades at a 15 times forward PE. Nvidia trades at 1.2 peg. Those companies are growing earnings. They're going to participate with the market rally. So those are opportunities to buy. United Healthcare, you don't buy right now. That stock is down 50% from the peak. And I'm getting emails like, hey, should I buy the dip on United Healthcare? No, not yet. They've got trouble. They have fundamental problems right now that they've got to resolve first. It'll eventually be a better buy. It'll be a great buy at some point. They're not going out of business, maybe. But until they resolve some of those issues, you may buy it at a higher price than it is today, but it'll be in a much better position. So, it's important to understand, the difference between a company that's had a decline and a broken company. And those are two very different things. And so when you look at your portfolio, just understand it's like, if some things are trading at a loss, that's okay. Maybe that's an opportunity to add to it. It just means you overpaid for it to start with. Or B, there's something fundamentally wrong with the company and you just need to sell it. You made a bad decision.
Yeah, there's a lot important, I think, wrapped up in that. One is Bill Fleckenstein put it really well this week, where he was talking about he's holding a lot more cash than he normally does. He's not going short. He's basically cash, some gold, and a couple of what he calls rifle shots. But he was talking about his stock mining miner position, where he says he's lightened up on for a lot of the reasons I think you were warning, Lance, right? It was heavily overbought. And he said, yeah, I didn't sell all of them, but I was thinking about it too much. And so I just started selling a little bit and I kept selling until I stopped thinking about it. And I was like, that is a great,
Yes,
simple way to do it right? To your point, right? If you're
exactly.
if you're up losing sleep, it's a great sign that consciously or subconsciously, your mind is saying you're too overexposed to this, right? So just start taking, you have to sell it all. Just keep taking a little bit of action until that pressure dissipates. And then, all right, you're probably in a pretty good space.
No, and that's true for any investment. And again, like I said, the risk you run if you're staying up late at night, threading over it, and the emotions building, eventually you're just gonna get to the breaking point and you're just gonna sell everything. It's like, I'm done. I got to get out. I can't handle this anymore. And that's generally the time you should be buying. But if you've been doing that risk reduction all along the way, you never get into that position. And then you have cash. And now when everybody else is freaking out, you've got the ability to say, it looks pretty cheap here. I think I'm going to
Yeah.
add a little bit more to my portfolio, or maybe I'll start a position in this. And if it doesn't work, no big deal. I'll just take it back off again. But that's the hard part of navigating this process. We wrote that article 2 weeks ago in our Bull Bear report talking about investing like Dr. Spock, and I'd gone back and pulled all of his quotes from Star Trek and about being unemotional and how that relates to investing. And that's a good read if you haven't read it yet.
Yeah. Kind of another part in this too, and you always advise don't get whipsawed by the headlines. You're almost better just sort of turning the news off and getting on with your day and maybe looking at your portfolio once a month or whatever, right? Um, uh, how many people do you think sold near the depths of the April lows,
A
right,
lot.
or the May lows?
I've talked to a lot of people that we're getting a lot of phone calls from people that sold right around those lows, and now they're trying to figure out how to get back in.
Right. Now imagine if you got knocked on the head in March and you got put into a coma and
Yep.
then you woke up today, right? I mean, short of a little bit of a headache, you'd probably feel fine about your portfolio, right? Because the market's actually green for the year now at this point, right? You were sort of saying earlier, everybody remember how bad you felt, on the day after Liberation Day. Um, again, it's our emotions that often are our worst enemies here, right? We feel like, oh my God, the world has changed, everything's going to hell in a handbasket. I'm sitting in all these losses. It looks like it's just going to keep on going down. I got to press that sell trigger and just get out. I can't take it anymore. And then oftentimes, a few weeks later, it looks totally differently. And I think this is the kind of market that we're in now. I've been talking with a lot of the folks I interviewed this week. I just recorded an interview with Peter Atwater. It hasn't come out yet. It's going to come out next week. But he's all about confidence, right? Tracking sentiment and confidence indicators. And we talked about how the market these days really doesn't have a sentiment middle ground anymore.
Right.
It is either Armageddon is unfolding right now, or tomorrow is so damn bright, I got to wear shades, right?
Uh,
And we've just seen that whipsaw in an incredibly short period of time here, just the past couple of weeks, right? We went from literally, Trump is breaking the world and sending the economy into recession/depression to I can't buy stocks fast enough now.
yeah. And that's an interesting point you make because as I track a lot of sentiment indicators. So we have our technical gauge that runs on a weekly basis. We have our fear greed index, which is all based about consumer sentiment and positioning, and we publish those every week. And what is fascinating to me is that when you look at that indicator as an example on the fear greed gauge, when it gets down to below 5, or really just say below 10, on that it runs the gauge runs from 0 to 100. So but when you get down below 10, that's super big fear, right? I mean, that's like financial crisis lows. And in fact, you go back to the financial crisis, you go back to the dot-com crash where markets were down 50%, that fear greed gauge was down at 6, 7 on that gauge. What's amazing to me is that really starting in 2020, all of a sudden this sentiment shift has just run crazy. That fear greed gauge, like for instance, we were down 35% during the pandemic, and we went from 92 on the fear greed gauge down to 7.
Yeah.
And then in in October of 2022, we had that 9-month correction, from January to October. And in October, just after being down 20% in the market ish, over that period, sentiment indicator was down below 10 again, and then rallied all the way back up to the 90s. And then to this past decline, this 19.2% decline, we got all the way back down there to 7. It's like, and you look at those gauges, and it's like we just went through financial Armageddon. If I stripped out all the other, kind of dates and everything that went on, I said, just tell me what happened, over this period. It's like, oh, well, there's, I know that's the financial crisis. And it looks like we just had 3 financial crises right in a row. So to his point, Peter's point, it is absolutely fascinating how fast sentiment is shifting in the markets. And this is because we've sucked all these retail investors in now, really since 2020, that didn't exist before. And the markets are now really hot money. It's just in, out, in, out, in, out. And that's forcing these indicators just to swing all over the place, which isn't a healthy market for the average investor, because it's just peeling their emotions back to the skin.
Yeah, and that's sort of what I wanted to focus on here, which is I think this is a sign of declining market health, and not meaning like, oh, we're going to roll over and have a massive correction tomorrow, but it's just that the market is becoming less stable. Its zone of equilibrium is getting narrower and narrower. And actually, the way I'm kind of thinking about it, tell me if this is the right analogy, is imagine like a path, like a wide path you can walk down, but it narrows the further you go down it, right? Until eventually it's kind of like a knife's edge. You're just sort of like teetering and, you know, very quickly going between one side and the other. That sort of seems like, as we go further and further on here, that's what it is. And you're either in crisis or you're in boom times.
Well,
And you can switch between the two really quickly.
from an emotional basis, yes. From the market basis, no. Right? I mean, there's been nothing this year. Yeah, I mean, tariffs were certainly like, we're gonna have tariffs, and then you and I talked about the facts like this is stick and carrot; these are going to go away. And as soon as we get to deal with China, this market's going to take off running, which is exactly what happened.
Yep.
But we're not in crisis mode. There's no crisis mode going on. We're not on the verge of a recession. Everything is functioning normally. The economy's doing fine. Retail sales were okay. We had retail sales today. They were,
They surprised to the upside.
yeah, they were up 0.1%. Well, they were a little bit less than expected. They expected 0.2. They came in at 0.1, right?
Oh, sorry. Year over year, they surprised to the upside.
Yeah, year over year. But year over year, they continue to be strong. That's 40% of PCE, which is 70% of GDP. So there's no recession data, to speak of. But yeah, emotionally, it looks like we go from boom to crash, boom to crash, boom to crash. But the economy and the markets aren't doing that. It just emotional wise, we're doing that. We're doing it to ourselves, right?
We're doing it to ourselves. I mean, I do think, and you would know better than I, but I mean, sentiment does affect things like capital flows and stuff like that, in the short term, right? So, anyways, I don't necessarily have a lot of confidence where to project what this dynamic might yield in the future, but I think it's just worth paying attention to.
No, I think that again, April the 6th, we had that super negative sentiment. I think you need to pay attention to sentiment. I think you need to buy. I just think you need to go when sentiment gets super negative, you need to be buying, and when it gets super positive, you need to sell.
It's the old Buffett, right? Be fearful when others are greedy, and vice versa.
And it's worked great. I mean, it got us in the market in October 2022, got us in the market last year, got us in the market this year. It's been working great. And maybe someday it'll fail, but so far it's working. So stay with what works, right?
Yeah. Okay. Well, look, I want to move on to some of the news we got this week, and to one point that I made yesterday in my live stream with Stephanie Pomboy, but I want to get your thoughts on it here too. And maybe since we're talking about sentiment and how the markets are really perking up right now, just some stuff that happened this week. So retail sales surprised the upside, as Lance said. U.S. factory production increased at its fastest year-over-year rate in 30 years. So we're beginning to see some signs of life in the U.S.'s commercial production, and producer prices plunged the most since COVID. So at least yet we're not seeing any notable inflationary price increases from tariffs. Now that still may come. For sure, could. Walmart, as you said, in their earnings call, they warned about, I think, quote, imminent price hikes that they're going to do based on tariffs. But there was there's been a lot of hand wringing, since early April that, oh gosh, prices are going to start soaring because of tariffs, and we really haven't seen that yet. And I know, Lance, you've taken us down the path of history, and you looked at the Trump 1.0 administration when we put tariffs on China there, and it didn't really manifest in inflation. So this is still a debate that folks can have. But right now, the hard data, as Scott Bessent keeps reminding the media, looks pretty good. Yeah, the soft data, not so great, but he's saying, look, I'm not going to worry until it starts getting reflected in the hard data. Right now, it doesn't quite seem to be.
Real quick just real quick on tariffs.
Yeah.
Barclays did a really good piece this morning. So post the negotiations with China, the average tariff rate is now 14%. So that's not too far above the 10% that the markets were expecting going into trade negotiations.
Mm-hmm.
And market was expecting like, hey, if we get 10% tariffs, we're okay, everything's fine. Because producers have to eat that. Now, interestingly enough, we saw this in the PPI report today, which was a lot weaker than what was expected. But what's interesting is in that PPI report is that and we talked about this before, the only people that pay tariffs are producers. Consumers don't pay tariffs, producers do. So the producer pays the tariff because they're the ones buying the product to make it into whatever good or service they're going to produce on the other side. Now, if they can pass on that tariff to the consumer, it results in higher prices to consumers. But what we're seeing, and this was in the PPI today, is that I run this analysis looking at the spread between PPI and CPI. And what that tells you is it tells you how much of the tariffs that producers are having to eat. And we're seeing them have to eat more and more of that because,
Right.
and this is Walmart made this point too, is that we want to try to pass it on, but we're still the leader in low prices, and they're going to have to wind up eating a lot of this stuff. So,
right. And sorry to interrupt, but I'm not crying too many tears because, as we've showed many times in the past, corporate profits are at the highest percentage that they've ever been. So it's like, look, dudes, you've been having a great time. Yeah, maybe you should eat this a little bit more.
yeah, logically, yeah, completely agree with you. Now, just from an investment standpoint, just understand that that's going to impact earnings and profit margin,
Yep.
which that's going to lower forward estimates, and that's going to potentially impact. That doesn't mean markets are going to crash, but instead of expecting a 20% return year, you might be looking at a 5 or 6% return year.
Okay. Well, so we'll obviously be tracking that really closely from here. Hey, real quick, just on tariffs. I'm not an expert here, but here's how a little tweak from my understanding is I believe it is the importer who pays the tariff.
Right. Well,
And
that's,
then
that's
and then the importer has to charge
right.
the domestic company that wants to buy the goods, and then that producer or that corporation then determines how much to pass along to the consumer. But I
So,
think the actual entity that has to pay the tariff is the entity that is bringing the product into the country.
so Apple, right? Apple's going to have to pay the tariff on the phones they produce in China, which is now why they're trying to move to India.
Right. Which Apple probably will, but a lot of people, I believe,
Yeah.
and folks in the comments can correct this, but I believe a lot of companies will buy from an importer,
Yeah, yeah.
right?
Yeah.
Yeah.
Tell companies that, they're import export business. That's all they do.
Right. And a number of these importers are actually foreign, they're US versions of foreign companies. So that company is actually paying the tariff first. The foreigner's paying the tariff first, and then they're going to pass as much of that as they can to the corporation, which will then pass as much as it can to the.
And most of those, though, but understand, like if you're a big company, like so you're Apple, you're doing your own importing.
Exactly. Yep.
Right? But to your point, and rightly so, your small cap, mid cap companies, and pretty much all your private businesses for the most part, kind of that mid tier cycle, they're not big enough to do the import side of the business. So to your point, there's whole company setups like let's say you and I want to go out and we build a widget. We're going to go to a plastics manufacturer that'll manufacture the widget for us, who then imports the plastic from somewhere else, so forth and so on. So there's a whole line of people that are dealing with that tariff before it even gets to us to build our widget.
Right. And my point here is that if the tariff is 100, the importer, may only be able to pass 80 of that to the corporation, who may be able to pass 40 of that to the customer, right?
Or in some cases can't pass any of it to the customer because the customer says, "Yeah, I'm just not going to buy that. I'm going to go buy something else."
Yeah, exactly.
And this is what we're seeing now is we're seeing consumer choice starting to come into a lot of this. And this is why we're not seeing the big inflation push. Consumers are tapped out. We talked about delinquency rates are rising.
Yeah.
Student loans are now the student loan default rate is spiking sharply because they've now gone back to start. You now have to pay off your student loan now. That whole forgiveness thing is over. And so we're seeing big jumps in student loan defaults and delinquency rates. And so consumers have to make a choice on what they buy and how much they buy of it.
I've got a really cool graph of that, which I'll try to pull up here in just a second. Um, yeah, and just to note too, Lance, it's not just student loans that are seeing increases in delinquencies, although they are seeing a massive spike, which I'm going to show right here. If folks can bear with me for just one more second. Do you see this chart, Lance? Lance,
Yes.
do you see this chart? Okay. Yeah. So this is percent of balance 90 plus days delinquent by loan type. And you can see they're trending up for all consumer credit types, but they're doing a moonshot right now on student loans. And this is because the rate was almost zero for the past couple of years because of the COVID student loan moratoria. And all of a sudden, now that they're suddenly getting forced to repay them, you've got a pretty substantial percentage of borrowers who are just saying, I just can't. I just don't have the money.
Can't do it.
Can't do it. And that is spilling over into other forms of debt. I've got another chart, but in the interest of time, I won't try to hunt for it. That's collectively all consumer debt delinquency rates, and that is now on the rise. And this is what Anna Wong, chief economist of Bloomberg Economics, was warning about when she was last in the program about a month ago. Is that she thinks that the student loan repayment could be kind of the match that lights the fuse here on the next consumer credit. I don't want to call it crisis, but consumer credit, problem.
But just curious, did she happen to say why? Because
Oh yeah,
because the only reason I ask is that it's not it's a good chunk of money, right? I'm not saying it's not, but it's not a massive amount of money, like relative to the amount of credit card debt or all the loan debt.
yep. So here it's a good question.
percent.
I will tell you why, and then you can react if you agree or disagree. So first, there are a lot of borrowers,
Mhm.
right? I don't remember the exact number, but I think it's something like 60 plus million borrowers. And there's about 10 to 15 million that are in kind of the red zone, where, as best we can tell, those people are going to be really challenged to start paying this back, right? And so what's going to happen is you're going to start defaulting on your student loans, but you're going to start defaulting on other loans of yours as well, right? So it's going to start rippling through. That's one factor. The other factor, which I found really interesting and hadn't really heard before, is she said just like sort of academically over the past several decades, we've had this grade inflation, right? A lot easier to get an A now than it used to be,
Right, yeah.
right? She says same thing with credit scores. So one of the things that the lending industry has been telling itself is, well, look, consumer credit scores are better than they were prior to the global financial crisis. So we've got a stronger consumer. But she's like, there's been a lot of credit score inflation over that time. And when you discount it back for the kind of grade inflation factor, she's like, they're really not that different. And so essentially what she's saying is that the credit worthiness of the average, household borrower is actually worse than the lending industry appreciates at the moment. And
Mhm.
right now, there's information asymmetry. The borrower knows their true state, right? They know their ability to pay pretty well. In a lot of cases, they're like, look, I'm not doing that well, so I'm going to borrow as much as I can get while they're still willing to lend it to me. But as if indeed we have this ripple effect of student loans now causing people to start having to, default or become delinquent on their debts, she thinks that the lending industry is going to start waking up to, oh my gosh, what, we've kind of been mispricing
Mhm.
credit risk here, and therefore we're going to start tightening lending standards, right? And that's going to start contracting consumer spending even further. So that's the concern that she has.
No, and I think that's a valid concern because the one thing I didn't think about, well, as you were talking, I started thinking through the credit collection process. I can file for bankruptcy and I can get rid of my credit card debt, right? But I can't file for bankruptcy, get student loan debt.
Right.
And more importantly, the government can garnish up to 15% of my wages to pay off that student loan. So I can't escape student loan debt.
Right. And that garnishing, I believe, has already started. I think that's what the administration announced last week.
Yeah, I don't quote me on this, but I think that has to be delinquent more than 270 days to start garnishing. It's a pretty
Maybe.
long stretch, but
But
still.
they basically said, look, these are the things we're going to do
Yeah.
to get this money if you don't pay us. Yeah.
Yeah, so back to her point, which I can see, or I can see how she's going with this, is that all of a sudden I've got this student loan debt. I'm trying to pay my credit card debt, my buy now, pay later debt, which is potentially on risk of going into default. And now they're going to start garnishing my wages, which gives me less money to spend. So yeah, there's to your point, there's this cascade failure effect, but I can't get rid of that student loan debt. I can file for bankruptcy, which is a whole nother issue
Right.
to get out of the credit card debt. But yeah, that's going to tell you. So yeah,
Right. And all of that depresses consumer spending, right?
yeah,
If I start getting delinquent, I'm spending less.
Yeah.
If I'm start having to well, look, if I declare bankruptcy, I'm definitely spending less. And if I go to borrow more and the borrowers say we're cutting you off because we've just realized you're a worse credit risk than we thought, you're
And
spending less.
now you're in bankruptcy, which means you get no credit. So,
Right.
and then
Yeah.
I think this is gonna be fascinating though, because I'm still waiting for that shoe to drop and all this buy now, pay later stuff. So,
It's coming, my friend. That's one thing I feel comfortable giving a guarantee to you on
yeah,
is we'll see those headlines. I'll take the under, 12 months or less. But I feel very confident we will be at some point. I'll be pulling up headlines and we'll be saying, yep, this is exactly what we were expecting.
yeah. I mean, this is like, I'm keeping a close watch on Affirm Holdings. That stock is doing okay right now. It's a public company that Affirm that
Right.
does buy now, pay
Did it
later.
recover? Because I think it did get whacked at one point, right?
During the April decline, but it's rallying with the markets now. Um, but what's the other one?
Klarna.
What is it?
Klarna, I think.
Yeah, Klarna's
Yeah.
about to go
The
public.
Scandinavian one.
Yeah, they're about to go public as well. So it'll be interesting to see if I'm not. Those are two stocks I will not touch. By the way, I'm not going to invest in them. Maybe I'll be stupid and I'll come back in a few years and say you were stupid not buying a firm. Look at it now. But
Yeah, I mean, honestly, it might, and folks
yeah,
don't follow me on this, but I think they could be fun, buy a long-term put and just, hold it
yeah.
for fun.
I think that might actually be the play. I am kind of excited though. They did add Coinbase to the S&P 500. They swapped it out from Discover Financial, which just got bought by Capital One Financial, and so they included Coinbase into the S&P. Now that is usually a death knell, so we'll
Yeah,
see.
is that kind of like a Barron's magazine cover or a John Madden NFL,
Well, if you
cover
if you
curse?
remember, well, if you remember, not too long ago, they put SCMI, the super microcomputer company,
Yep.
into the S&P index, and then it promptly went down 60%. So we'll see what happens with Coinbase as they get added to the S&P. But it's an interesting ad for the S&P. I like it.
All right. And look, it's been a long time since we've talked about Bitcoin and blockchain and crypto. If there's interest in the comments here, Lance, maybe we'll bring it back up. I will. I've had folks asking me because I mentioned at one point in time that I did know uh, Brad Garlinghouse, who's the CEO of Ripple, back in my Yahoo days, and asked folks if they wanted me to get him on the channel. Enough folks have wanted me to. I have reached out to him. I haven't heard back yet, folks, but just know I am still trying to follow up on that.
He's probably
Um,
going, who, Adam?
yeah, probably, yeah. All right, so let me get to this next point, which again, apologies for those that watched my section with Stephanie to see me go through this again. I'll try to do it quickly. I also want to preface it. So Lance, last time, we talked about kind of the slings and arrows we take whenever we talk about the current administration and its economic policies. People on both sides of the political spectrum see it as a more partisan, or see it as partisan, which is absolutely intended not to be. So real quick before I make this point, I just want to react to this comment. A fellow commented in a recent video saying, "Hey, I've enjoyed your commentary for years, um, uh, and really like how you are, it was your candid, independent voice that drew me to your channel in the first place." He says, "Lately, however, your commentary has increasingly leaned into support the current administration in a way that comes across as sycophantic, and that's disappointing. Let the administration's wins stand on their own as realized gains, but recently your tone feels more like proselytizing than analysis, and it doesn't feel authentic." Um, that individual is completely they're welcome to their own opinion.
Yeah.
I just want to clarify, none of my approach is to try to endorse any particular partisan agenda here. And at the core of it, as we talked last, Lance, is like I've got a choice, right? I can either say, look, whenever I talk about the administration's, whatever administration's in office, what their policies are, that's going to get interpreted as political, and we're going to have a mosh pit, slugfest out in the comment section. And man, I just won't touch it, right? That's one decision I could make. The issue is that so much of the future outlook these days, like it or not, is being policy driven, much more so, I think, than in previous years or past decade for sure. So I feel like to ignore it is to do a disservice. It's to actually, you know, somewhat blind the audience here to significant material inputs that are going to affect what comes down the road. So, anyways, folks, I'm going to continue doing this. You can, if you doubt my intentions, whatever, that's up to you. But I really am trying to do this because it's essential to understand where the macro outlook is going. And I really do not have a dog in this fight in terms of political parties. My brand and just myself as an individual is very independent, very moderate. Now, that being said, I will do my best to call balls and strikes, right? So I'm going to say some nice things. I'm going to say some critical things. So that being said here, Lance, here's the overall point I want to make. Um, I think that there's a number of people that didn't like the current president when he got elected, right? And said, look, this is going to be a clown show, right? I totally don't trust this guy's ability to run the country. He's going to run us off the rails. I think there's a material percentage of the base that voted for Trump who have been uncomfortable with the level of disruption that's been unfolded so far. And even they have had their doubts, right? Especially even after Liberation Day. Whoa, wait a minute, this guy, I thought I was on board, but I don't understand what he's doing here. I think he's turning the world against us. I think, Sheriff, you're kind of even raising your hand a little bit, right?
Including.
So all I want to say is if your investment philosophy is informed by uh, Trump is imploding the economy and turning the world against us, right? If that's your default plan A and your investments are reflective of that, right? I think at this point in time, you have to be cognizant that there is momentum building in this administration's agenda, right? And that if your assumption is it's a 100% clown show, I think you ignore this momentum at your danger. Now, I'm not saying this momentum is going to end up in Trump being successful on everything. There is plenty of time, plenty of opportunities for this train to go completely off the rails at some point. But let me just walk through a number of accomplishments that I know the administration is touting, right? So on trade, right? We've got the UK deal, right? China, for whom everybody thought was going to be the last party to engage and come to the table. Well, now we're meeting with them, right? We had the meetings in Switzerland this past weekend, and presumably we've agreed to some high-level based terms, right? And already the tariffs have come down materially, as you said, Lance. A number of agreements have come from Trump's recent visit to Saudi Arabia. They're going to buy billions in US chips, a whole bunch, like 160 Boeing planes or something like that. There are a number of other big country deals in the wings that the administration is telling us about. You can doubt that, be skeptical, whatever, but just ask yourself this. If you are one of those other big countries and you've now seen the UK seal a deal early and that China is at the table, are you more likely to be leaning back and saying, nope, I'm not going to play this game? Or are you going to be more likely to say, look, I want in on that. I want to get to the table now and strike a deal while the getting's good, right? I think it's probably much more likely the latter. We've got, as the administration tells us, 75 plus other countries that are ringing the phones off the hook to strike trade deals as well. And what the administration has said is yeah, we're going to pick up the phone on some of those. But for a lot of them, the smaller countries that we're not really that economically dependent on, we're just going to give them a deal term, right? And we're going to say, hey, look, here's the deal we're willing to take. Take it or leave it. You don't like it? Don't worry. Go do whatever you want to do. But you want to do business with us? These are going to be the terms. And so you're just seeing a lot of, positive momentum, wins starting to come on the board trade-wise, right? And everybody who were very understandably worried about the administration driving the rest of the world into China's arms, that does not seem to be materializing, at least as of yet. We're going to get those 10% tariffs, it seems, pretty much on everybody. That's going to be the Costco fee to do business in the US consumer market. That tariff revenue is going to come in. It may be used to reduce taxes. It may be used to pay down debt. But that is revenue that is coming into the country. And as these trade deals are getting struck, there's also commitments of investment in the country, countries that want to avoid tariffs by building their factories here employing U.S. workers. The latest count that I've heard is over 10 trillion in commitments so far. Now, a lot of this is announcements. We'll see how much of this really manifests over the next bunch of years. But they're getting a lot of countries that are going on record saying, yeah, I'm going to put countries and large multinational companies saying, yeah, I'm going to put $500 billion, $1 trillion, or whatever into the U.S. going forward. U.S. inflation's the lowest in 4 years. We had a surplus in April, not a deficit. The S&P is now green for the year when everybody was freaking out that Trump was sending the stock market crashing and the economy into a recession or depression post Liberation Day. We then also have a lot of things that are in the works economically. The big beautiful bill is making progress through Congress. Still could get derailed, but it is building momentum. They've got deregulation. They've got the DOGE cuts, budget reconciliations. They've been shrinking government departments. We saw the executive order of reducing prescription drugs by 30 to 50%. And of course, the reshoring manufacturing that I mentioned earlier. Geopolitically, we've made substantial progress, or I don't want to oversell it, but we're making forward progress towards a Ukraine-Russia ceasefire and potential peace deal. And in fact, Zelensky, the day we're talking here, Lance, is in Istanbul meeting with Russian envoys. The Houthis stopped targeting U.S. ships. India and Pakistan, the ceasefire was negotiated by the U.S. The last U.S. hostage in Gaza has been released. Trump was also over in the Middle East talking to the countries that fund Hamas, trying to further get to a permanent ceasefire. This morning, news came out that we've basically presented Iran with a nuke deal that Iran seems to at least be open to discussing. So all of a sudden, we're seeing the prospects for peace dramatically increase around the world right now, with America playing a key role in that. And then also, in terms of NATO, the NATO countries have agreed to step up and pay more of their fair share of NATO costs, which is a cost reduction to the U.S. So, there's a whole bunch of other things. Of course, there's the border security, lowest amount of crossings on record now, and a bunch of other things as well that I won't get into because they're not necessarily economic related. But all I want to say is that is a lot, especially in 120, 130 days. Now, not all of it's going to be successful. Like I said, a lot of this could still go off the rails here. But to my point is, just like you say, Lance, if you have a sense that economic Armageddon is where the macro story ends at some point in time, you don't necessarily want to put all your chips on that now, right? You want to be invested in the market in other ways, in the ways that you and I've talked about in the past. I'm saying the same thing here, which is if your money is bet on clown show, that's fine. But I wouldn't have it be 100% that way, looking in the face of which way the momentum is moving here. And I'm not trying to convince you that the Trump administration is going to succeed here. What I think you need to ask yourself, though, is how much of the market is going to start getting more and more convinced that this is going to happen, because that's what's going to drive asset prices. So I'll take my breath here. I'll let you respond to this. We'll then talk about how this could all be screwed up, so folks feel like I took a pro and a con side here. But Lance, what are your thoughts?
Well, no, I think it's, I had this conversation this morning. So one of the comments in my chat this morning was, all the inflation data is rigged. It's been rigged since 1980. Okay, it's not true. But, you can think that, and that's okay. You can think that the employment numbers are rigged. That's okay. And look, there's a lot of problems with the employment numbers. There's a lot of problems with the inflation numbers.
I was going to say, I think we can debate whether they're rigged. I have a less issue debating that they are not super accurate.
Right. No, and right. No, and that's fine, right? Yeah. And this is the same thing as having a political conversation, right? But the point is that the markets don't care about that opinion. What the markets care about is what was the employment number, what was the inflation number, and what's that mean? And that's what markets are going to trade off of. And I get into a lot of these, and again, I'm not political one way or the other. I'm like you. I'm looking at just the politics for what they are. But say, hey, look, this is going on. And I told you the story when I used to do political commentary back during the Obama administration, is that you could have a reasonable conversation with somebody about this and we could debate points. Now it's, this whole idea is orange man bad. It wouldn't matter if Donald Trump came out tomorrow and announced a cure for cancer. No, he even said this during his address. there's just a group of people that are just going to be against it, right? It's like, oh, you're supporting Trump, so you're a sycophant because you're supporting Orange Man bad. That's not a logical discussion, right? That's not a good debate point to have. And if that is your viewpoint, where you're ignoring all of the other data that is surrounding that viewpoint, you're on the wrong side of the trade. And you need to start reevaluating, to your point, Adam, saying, look, this is what's going on. Like it, hate it, doesn't matter. What does it mean to your money? Because that's all we're here for. We're just here to make money. And we need to make sure that we're analyzing the data appropriately, good, bad, or indifferent. And look, like I was holding my hand up earlier, I was the first one out there saying this tariff announcement is really bad, right? This is going to be bad. And the market sold off, and a lot of people that hated Trump loved the sell off. And now that the market's rallying back, now they hate Trump because this stuff is working. And again, may continue to work, or it may not. We'll see. But having this really narrow focus on just hating a person just because he's in office is not a good position to be in. And you have to ask yourself this question: if your whole view is I hate this administration because Orange Man bad because that's what the media tells me, what if it was somebody else? What if it was some other individual that was a conservative that was the president and it wasn't? Would you feel the same way, or would you be more open to what was going on if it was just an individual that was if it was Adam Taggart, right? He's now the president of the United States, just a normal everyday American is now president. Would you have a different opinion about what was going on? If he's doing exactly the same policies, would your opinion be different? Or is your whole opinion based on Orange Man bad? Because that's what the media tells you that it should be. And if that's the case, I think we need to really, really evaluate where we're getting our information from. Is that information actually valid? Is it taking in all aspects of what's going on? And because that's what news used to be. News used to be fair and balanced, right? It's not anymore. It's very divided. You have, Fox News on one side, CNN on the others. There's nothing in the middle. But we have to evaluate both arguments for their validity and then try to make our decisions based on the facts, not on emotions.
Okay, well put. The only tweak I would put to it is yes, for Orange Man bad, but I would say the same applies to Orange Man perfect, right? And you get people on both sides. Yeah, exactly. And to your point, Lance, I think the key thing that I'm trying to get across to folks is what you really need to consider is, assets are priced at the margin. So what does the marginal buyer or seller think, right? And so do you think they're swayed by this long list, or do you not, right? And you got to take your personal biases out and just try to analyze the market, because that, to your point, Lance, is how you're going to make money, right? So, all right. So let me ask you two offshoot questions of this. The first one is so let's say the Trump administration is successful with all of it, right? With renegotiating these trade deals, bringing world peace, extending the tax cuts, adding additional tax cuts, making a lot of progress with deregulation, cutting government expenses, both in terms of bureaucracy and fiscal spending, the whole kit and caboodle, right? How material do you think an impact do you think that'll have on the American economy? And when do you think we should start, because it takes time for all this stuff to ripple through, when do you think we should start to know that it's actually working?
You'll probably know by next year, early next year. So again, we don't have a tax cut bill, right? We don't have a big beautiful bill yet. That's still to come. So all we have.
So when you say we should know, meaning it'll be reflected in the data, or the market is going to react? Because the market will react before, right?
Yeah, the markets will react before. But markets tend to lead the economic outcome. And I think what the market's starting to tell you is that the outlook is getting better. Estimates are starting to come up. People's forecast for economic growth is starting to improve. Recession odds are falling pretty sharply here. And that's kind of all that bet. Now, that's just based on tariffs, right? So this reduction in tariffs, getting better trade deals set up, the ability, which what everybody's forgetting with these tariffs and this deal is that this will allow us to export more goods, which is about 40% of corporate revenues. So if we can export more goods because we've now reduced tariffs in other countries or opened up better trade deals, That's good for the U.S. So that's going to increase employment. Ultimately, that'll increase earnings. That'll increase profit margins. That'll increase economic growth rates. So that's going to have more demand in the economy, more jobs.
Right,
So
which is, just to be super clear, you can boil down the administration's policy, I think, at its most reductionist, is spur growth and contain China.
right, that's pretty
Yeah.
much. And if you do that, then you're talking about growth. Instead of running a 2% growth rate in the economy, maybe you're running 3.5, and that would be great. We haven't seen a steady 3.5% growth rate in decades. So, it would be good if we could get economic growth back above the population absorption rate, which is 2% growth. 2% growth, you're just absorbing population. But if we have job growth above 2%, now all of a sudden that fosters higher wages. That's going to foster a better standard of living across the aspect of the economy. There's a lot of good benefits for that, and also lead to higher stock market prices ultimately, more demand, higher earnings, et cetera. So there's a lot of flow through from that. So if he's successful in getting done what he's going to do, and most importantly, the one criticism I have of all this that he's doing is he's doing a lot of this by executive order, which can be immediately undone by the next administration. So we may get a lot of great deals put in place, and then the next administration comes along and, no, we're not going to do any of that anymore because, we didn't, Orange Man bad, we're not going to do it. So we just get rid of it all. If this was done through legislative process, that's a much different story. And that was one of my arguments with you earlier, is that, I wish that if you're going to do these tariffs, you go through Congress, you get these tariffs done through a legislative process, which makes them permanent.
Right. And my response to that was, listening to the administration, I don't think they felt they had the time to do that, but they do want to do it retroactively. And that is the risk, that they're unable to, especially if it doesn't happen by the midterms and they lose Congress in the midterms.
Correct. And so there's a lot of risk. But if this things work as expected, you should see better economic growth, better employment, better wages. Things should be better.
Okay. So better, and I'm going to get to the negative in just a second, folks. I'm just asking you to guess here, Lance. No one's going to hold you to this, but if we do enter that world, right? Well, which we'll call Trump's, what's he calling it? The golden era, the new golden era of America, golden age, whatever, right? Where do you see the stock market going?
Well, I mean, the stock market should, at that point, I mean, you're going to start generating, 6, 7, 8% rate of return years. You'll have some years better, some years, maybe not as much. I mean, but markets will be higher. They're going to grow at the rate of economic growth. So if you want to know where the markets are going to go, it's economic growth, inflation, and dividends. So if you have, and history goes back over time, shows you this, until just this last decade, we've really skewed things up because of all the monetary stimulus and stuff. But prior to 2008, from 1900 to 2008, the economy grew at about 6%. Your dividends were 4%. Your return in the market was 10. So there you go. So going forward, if you're growing at 3 and your inflation rate is 3,
well, it'll be 2. Let's just give the Fed credit. As in this perfect world, let's assume the Fed hits its target. So inflation's 2.
Well, you can't have 3% growth and 2% inflation.
You can't?
No. Inflation is going to track economic growth because it's supply and demand. If you have stronger demand in the economy, then corporations can charge more for their products because you have more employment and more demand. So that's going to lift inflation.
Okay. All right. So, all right, let's continue with this. And I don't get wrapped around the axle here.
Right. Okay. But it's just however you want to do it. So 3% growth, 2% inflation to you, that's 5. Add in dividends at 2, that's a 7% annual return.
Okay. All right. Okay. But I mean, so that is an attract. I mean, I guess when you compare it to the 20% returns we had in 23 and 24, when things were getting juiced, maybe it's a little boring, but
But remember, that's average, right? We're talking about average returns, right? And so that means that one year you've got a 15% year, the next year you got a 5, next year you got 10. You never get an average year. Markets don't ever return average. They're all below.
Okay, but I guess back to your point, better. Okay, so that's our maximum upside, right? Now let's get to maximum. Pardon me?
No, there's more upside. If AI does what we think it's going to do, and where we're placing some of our bets right now, then the increase of productivity, which is not good for employment, but the increased productivity and earnings can certainly provide a very big boost for the markets.
Okay, for the markets. Okay, and we'll save the societal cost, dark side of AI. And that's actually,
Societal cost be damn.
yeah, and that's actually, if we have time for today's rant, which we might not, but it's actually about that. But real quick, so let's flip it. Okay, so China flips over the negotiating table and walks away. Uh, uh, our other countries, we've injured, we've insulted them. They start cozying up to China. The big beautiful bill doesn't pass. None of this stuff passes. We lose, or sorry, the Republicans lose the Congress in the midterms. How bad does bad look like here? If the Trump clown show really does materialize.
Okay, so talk about a recession, probably 1.5% negative economic growth. Market's going to have a retracement probably back towards, the 2022 lows, maybe it could be even back towards the pandemic lows at some point, just to reevaluate the markets for lower earnings. So, you've got 20, 30%, maybe 40% downside over the course of time.
Okay. Okay. So that's that's the other end of our spectrum.
Yeah.
Right. Okay.
Those pretty, I think it's somewhere in the middle.
Probably. And that is the point that's the whole point I'm trying to make here, right? Which is, determine where you are versus complete clown show versus pristine golden age of America, right? Where in that spectrum are you? And then come up with your expected value between the boundaries that Lance has laid out for us here, right? Don't just dogmatically pick one side and say, my gut just tells me this is really going to happen, or ideologically, I just really want this to happen, right?
Exactly.
Yeah. Okay. All right. So yeah, let's squeeze in this rant. There was an article that I read. I won't pull it up here in the interest of time. But it's about how artificial intelligence, its impact on society and the workforce is not just coming, but it's increasingly already here. And it's a story about a software engineer who had been working, I believe, for about 2 decades. He had been a software engineer during the global financial crisis, so he's been around for a good while. He lost his $150,000 job a year to AI, and he lost his job twice before, once during the global financial crisis, and then once during COVID when everybody got fired. And in both times, he was able to get a job within a matter of weeks programming, right? Now he's been rejected from 800 jobs, and he is forced to be a DoorDash driver and live in a trailer to make ends meet. And he's just basically saying, look, I used to think that my job was pretty bulletproof, right? I mean, the whole mantra, right? Hey, learn to code, right? Safe job, right? We've all heard that AI is increasingly taking over the programming stack. And to date, it's been, okay, well, really basic fundamental stuff. Well, it's now crept up enough where he's like, look, I and a lot of guys that I worked with have gotten laid off. We can't find a job anymore. In fact, for the few jobs in which he has been like called back to interview for, in more than one occasion, the interviewer was an AI bot. So he wasn't even interacting at that point in the recruiting stage with a real person yet, right? So he's basically just saying, like, look, the job killing aspect of AI is here, and it's not just here for low skill jobs. It's increasingly hitting really substantially skilled jobs, like as fairly senior software programmer. So you and I bring this up, Lance, because you and I have talked about both the promise and the shadow of AI, and I've said many times, and I know you've said too, but I just, the biggest issue I have about getting excited about it in the future, and there are some amazing things it's going to do for us and for our economy, at least for the top end of our economy. I just still can't see it as anything other than a massive jobs destroyer. And I go back to that theory of Keynes, of technological displacement, which is if technology can replace labor and do a better job more efficiently, you should absolutely replace that labor, but you have to throttle the rate at which you displace the labor. If you displace the labor at a faster rate than you can repurpose to something else that's constructive, you create a social crisis, the cost of which is larger than the benefits you get from the technology transition. And to me, it just still feels like we are hurtling blind, into this chasm of displacing too many jobs that we know how to, redirect that labor to.
No, my son's a computer science major at A&M, and he's got he's in a couple of different organizations, and he's really evaluating his final year and a half of what he's studying, because he's, to your point, he says, I've got a lot of buddies that have graduated, can't get a job, and they're coders. And like, everybody's like, hey, if you're a
That's
computer,
going to be frightening. That's going to almost be like going to med school and coming out and they're like, sorry.
don't need you. Yeah. So it's a very fascinating situation, but it's interesting. I've had this conversation, on our radio show, is that, this is something that's happened over and over again. And we see this happen, but we just kind of ignore it later. But there used to be a time when you called any business and there was a live person that answered the phone and says, hello, thanks for calling, Adam Taggart's, thoughtful money.
Thoughtful money. Yeah.
Right. And
by the way, I will still answer the thoughtful money phone line.
Just, there you go. Good. Right. Because
we're old school here. Yeah.
Exactly. But how many businesses you call today, there's not a receptionist. It's like dial 1 for English, dial 2 for Spanish, and then we'll, dial, and then you get to another menu tree with 14 different options. You're just trying to figure out and get to where you want to go.
And sorry to interrupt, but I just want to underscore this because it's a huge peeve of mine. I'm in the business of trying to track people down to have them come on the show. Increasingly, websites don't have contact us. Yeah. They not only do they not have a phone number, they don't even have an email address.
Yeah.
Right. So, it's increasingly hard to contact any company that you've got potentially a grievance with. Yeah.
Exactly. And look at all the apps that we have today that, if you have a problem with DoorDash, who do you call? Right. It's like, it's just, but we've displayed, my whole point is we wiped out a whole job category of reception. It's like, oh, it's just receptionist, who cares? But that's the problem with technology, is that if you take a look at the number of people we have in the United States that are of working age, you got 190 million people that are of working age. You have about 100 million people that are just sitting on the sidelines somewhere doing what? I don't know. But they're out there. Okay, yeah, they're working multiple part-time jobs, or no, they're going to school. There's lots of excuses, and maybe those are true.
Well, you've also got Nick Eberstadt's 7+ million that are just doing nothing, right? Yeah. Working age that are doing nothing. Yeah, they've checked out. Yeah.
Exactly. And well, why aren't they doing nothing? Because there's no job for them. And so my concern is, and first of all, companies don't care. This is all about profits for them. And you and I talked about, I think, last week or week before, about AI is going to generate this massive boost of GDP per capita. Well, that's great if you're in the per capita part that's benefiting from AI. Right. You have a boost in GDP, not everybody else will. But the AI is going to go after not just coding. It's going to go after paralegals and administrative assistants and people that work in doctors' offices and all. Right. This.
Well, and doctors, radiologists, all sorts of things. Just to be clear, I'm going to let you continue, but it's not going to go after them. That's the whole point of this article. It is going after them.
That's the whole point. This is not going after low wage paying jobs. This is going after every job. And, maybe if you're a plumber, you're safe. I don't think
for now, until Tesla's, Android robots come. Yeah.
But yeah, it's fascinating. It's awe-inspiring, but it's scary about what the future is going to look like. And for me, I don't care because I'm almost dead at 60. But my kids, I worry about them and what their future is going to look like.
Yeah, and I don't have a lot of solutions on this one. I didn't mean to, bring people down here at the end of the discussion here. And it's funny, we call this the rant, but we normally try to put a positive spin on things here. I think here, look, there is a lot of benefits that's going to come on here. And while we're still processing this in real time, Lance, I guess my advice to people would be, this is not something you can ignore, right? You ignore it at your peril. So you do need to start learning about AI and its applications and its potential. And if you are an average viewer here, you're probably somebody who's 50 or older, you probably have children. Your role here, I think, is not to necessarily figure out how you are going to leverage AI going forward, although you definitely should do that if you can. But it's to really be a partner with your children and say, okay, how can I at least help you understand what's going on here so that you can figure out how to play in this world, right? That you just don't blindly go into a field that is just going to get completely eaten by AI. Figure out how to either use AI to succeed in your job and be one of the people that outperforms, or, do you look to work in a field that is AI supportive, right? That as AI grows, your opportunities will grow as well.
Well, I think that's for the positive spin on this is that we just have to do, and this is basically just your point, is that the AI is going to be destructive to those that are not doing something with AI, right? So if AI can replace your job, then you're in trouble. But there's going to be a whole group of people that figure out how to leverage AI to their benefit, and they will be able to use AI to generate more wealth. And that's going to be the definer point. And again, so we're talking, that's what I said is I know the problem with GDP per capita is it's an average. It just assumes everybody's participating equally. That's not what's going to happen. So, and this is what I talk to my kids about is make sure they're in, they're looking ahead and saying, either like to my son who's in computer engineering, I'm like, look, you have a choice. Either you can go be a coder and that's going to go away because AI will do it, or you and I need to figure out a product we can build using AI
Right.
that we can charge money for and we can make money off of AI. So, and that's why, like, very soon, we're very, very close. We're about to roll out. We have a whole AI engine that we're adding to SimpleVisor where you plug in a stock and it analyzes it using AI, like Ben Graham, Phil Vischer, all these great investors, Warren Buffett, and it analyzes them as if they were actually analyzing the stock using their metrics, their analysis, all that was all AI generated, gives you a whole narrative around it. It's really cool, but you can get a whole score based on all these different great investors over time as if they were actually sitting there talking to you about that stock you want to buy.
Oh, that's super cool. So you could talk with Ben Graham, to actually chat with Ben Graham, thinking about, should I buy this company? What do you think, Ben?
Yeah, you say I want to buy Google, and then Ben Graham will say I scored this way because of this.
That's so cool. And then you can turn to Peter Lynch and say, well, Peter, what do you think? Right. And you can see that's really pretty awesome. Look, when that's live, we'll have you walk through folks through it here on the channel. That'll be super interesting.
Yeah.
All right. Okay. Well, look, we'll end it there. But sorry, folks. We got to the rant before I asked Lance about his trades. I normally flip that around. Sorry about that. Lance, trades. Have you guys made any trades over the past week?
Today, actually, just before we got on air with you, we had bought energy stocks a few weeks ago when oil prices were extremely beaten up. We bought some ExxonMobil and Diamondback Energy. We sold those today, took some gains on those, and we did add some money to our one OK position, which is symbol OKE. That's a natural gas pipeline. That's part we had owned that for a while, made a lot of money with it. We reduced it going into the whole April sell-off, and we're adding back to that position now because again, that's our part of our AI trade, which is that power gen is going to be critical for data centers. And in order to generate power, I think I showed you that chart last week, is that a lot of the power generation, nuclear is going to be important in the future, but it's not going to be as important as natural gas, which is the lowest cost production of energy.
Right. I think in Doomberg, I recall from my previous discussions with them, natural gas is going to kind of be the bridge
Yeah.
fuel, and it's probably going to be a long bridge time-wise, but it's what we've got the most of. It's the cheapest, and it takes a long time to get nuclear up and running, and who knows how much of a percent that's going to be in the future. Hopefully a lot, but even if it is, it's going to take a good while to get there. So in the interim, and then also natural gas too. I think we talked about this. It is highly likely one of the bigger bargaining chips that's being used in these trade deals right now, which is, hey, look, we'll take tariffs off, we'll make all these concessions, but a big part of this is A, you got to be on our side versus China, but
Yeah.
B, you got to buy our planes, you got to buy our natural gas, that type of thing.
And look, natural gas, it's abundant, it's clean, it's cheap. it's great. It's very efficient. The thing about energy production is really comes down to efficiency. Is how efficient is it to turn it actually into energy? Oil is very efficient to turn, and you get a lot of energy out of a barrel of oil. You get a lot of energy out of natural gas. Solar, wind, those are great, but they're not nearly as efficient or as cheap to produce as it is to get out of natural gas or oil or even coal. But natural gas is by far the cleanest and most efficient way to generate energy.
Yeah. Fossil energy, but yes.
Yeah.
Okay. All right. So those are your trades. All right, folks. Well, look, in wrapping up here, well, let me just put it this way. Please show your birthday appreciation for our good friend Lance here, our sexagenarian, by hitting the like button 60 times, and then clicking the subscribe button below only once, and only once in that little bell icon right next to it. Very importantly, if you would like to get some professional help in guiding your financial portfolio for the road ahead, and Lance and I talked about all the different potential permutations the future may take. So anyways, if you want to get some help with that, highly recommend that most of the viewers here get it from a good professional financial advisor. Importantly, one that takes into account all the issues that Lance and I have talked about here. But if you'd like to get some guidance from one of the professional financial advisors that Thoughtful Money endorses, maybe even Lance himself and the team there at RAA, then fill out the short form at thoughtfulmoney.com. Only takes you a couple of seconds to fill out the form, and the firms will be in touch with you right after that. All right, Lance. Well, look, as usual, my friend, I'm going to give you the last word.
I saw you eating earlier, so I'm going to go eat lunch now because I'm really hungry.
All right, I did that off camera, but thanks for adding me. All right, my friend. Well, look, thanks again for another great week. Everybody else, thanks so much for watching.